Today, growing mortgage pain has consequences as forced sales rise. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today I want to discuss the issue of mortgagee sales and forced sales more generally, as households are being put under significant pressure as interest rates rise. And it's worth saying that the banks are being quite aggressive with some people, trying to convince them to sell before they start foreclosure proceedings, because of course that means that they don't register as in default in the bank's books. But beyond that, we also know that the number of mortgagee sales in Australia has recently surged, although it's still much lower than the volume taken to the market during the COVID-19 pandemic. That was according to data from Ray White Group, which showed that the number of mortgagee sales lifted in the 3 months to July as interest rates finally increased. And in fact, to determine the rate of mortgagee sales, the group's research team identified listings on Domain and other advertised portals which featured the word mortgagee, tracing back to the start of 2020. Postscript there, that won't tell you all, because quite often real estate agents don't necessarily declare a mortgagee sale in the listings. Homeowners were definitely feeling the pinch from the removal of mortgage repayment freezes during COVID-19, with distressed listings hitting a peak of more than 250 properties in October 2021, prior to a steady decline over the 6 months to about April this year. In Australia, with interest rates increasing there, the costs of living rising and particularly high debt levels, there has been a lot of discussion about mortgage stress, wrote Nerriga Crosby, Ray White's senior economist, in a weekly property economics report. The ultimate outcome of mortgage stress is being unable to pay a loan and the property becoming a mortgagee sale. Well, that's a bit simplistic, of course, because, as I say, the banks are actually bearing down on people before they get into that forced sale situation. But nevertheless, Crosby said the figures started rising from March 2020, driven by the recession at that time, and were then mitigated by repayment honeymoon periods for mortgage holders. The number of mortgagee sales, however, didn't increase as much as they could have during this time, given that the banks offered 6 months mortgage payment freezes from the end of March 2020, she said. And according to the figures, the rate of mortgagee sales took a dip at the end of 2020 and 21 as market conditions got better and the short recession ended. But not surprisingly, the biggest increase we saw over this time period was when mortgage payment freezes came to an end in March 21, Crosby said. Despite a red-hot property market and an economy that was getting back to normal, the number was elevated because borrowers who were in mortgage stress were helped through by the freeze on payments. But right now, we've seen a pickup in mortgagee sales. However, at this point, they remain below what we have seen through the pandemic. And also highlights how important the support of banks is when it comes to helping people through mortgage stress. Just make a point here, of course, it takes a couple of months for the impact of those rate rises to flow through. So already we're only really seeing the impact of the May and maybe now the June rate rises from the RBA. Of course, there are more rate rises coming too. Mortgage holders, Crosby said, will now be prepared by low unemployment, well-capitalised banks and high levels of savings, with Aussies tucking away rainy day money during COVID-19. Well, some did, some didn't. But I have to tell you that in my surveys, a lot of those in mortgage stress have no buffers at all. It's not equally spread. But of course, rates are continuing to rise. And Westpac, for example, has announced that it will pass on the Reserve Bank's August 0.5 percentage point hike in full to its variable loan customers. The major bank said it will also increase its lowest variable rate by 0.35% for new customers, taking its lowest variable rate to 3.49% for 2 years, after which time, though it increases by 0.4 percentage points, to get that rate, borrowers will need to be new to the bank and own at least 30% of their home. Westpac's new lowest variable rate at 3.49% is extremely competitive, but it comes with plenty of catches, said Sally Tyndall, RateCity.com.au research director. This rate is exclusively reserved for new customers with a decent amount of equity in their home. The discount also only lasts for 2 years, after which time it automatically jumps up by 0.4 percentage points. And Tyndall said that with new customers getting a better deal, loyal existing customers may find this difficult to swallow. Instead of getting angry, get even, she said. Have a look at what your bank is offering new customers, but also what other lenders will offer you. If it's lower, pick up the phone and ask the bank to cut you a better deal. Once the August hikes filter through, a competitive interest rate for owner-occupiers is likely to be around 3.5%. So if your rate starts with a 4 or even a 5 as an owner-occupier, then you really should question why. And after 4 consecutive interest rate hikes, homeowners are already paying significantly more on their monthly mortgage repayments. And as a result, many mortgage holders are considering refinancing their home loan and are shopping around to find a more competitive rate. Last year, the Finance Brokers Association of Australia conducted research which found many mortgage holders were not prepared for these hikes and are now under financial stress. FBAA Managing Director Peter White spoke to Australian Broker and wanted to warn people who are considering switching lenders. When it comes to refinancing, there is a hidden danger at times that is rarely spoken about, he said. Banks will be looking to attract those considering refinancing as new customers and will offer cheaper variable interest rates that are significantly below their fixed rates, which are rapidly climbing. This is a case of buyer beware. He said brokers are experts and they are free. They can help borrowers evaluate all the options in the marketplace and ensure as best as possible that refinancing works for them. A broker is obliged to act in the best interests of the borrower, whereas banks are not. Brokers have access to second-tier and non-bank lenders that borrowers may not be aware of and will look at all refinancing options so can frame an outcome that meets the borrower's needs. White said nothing is free and cheaper does not always mean better. When banks offer cheap variable rates to new borrowers, they are in fact disadvantaging their existing customer base who are subsidising the new customers, he said. Borrowers should be aware that next time around they will be at the existing customer facing higher rates and will be disadvantaged during rate increases. It's an old game to new customers with a perceived advantage, only to be taken advantage of with the next move. So White urged borrowers not to focus solely on the interest rate and carefully consider all of the options offered by a lender, including fixed rates and their specific needs. Remember that brokers are bound by legislation to ensure they act in the best interests of the borrower, not the bank, he said. Lenders are not under any obligation and will act in their own interests. If this means giving you something now, only to take it back later, they will, and there is nothing you can do about it once you've signed up. White said it could be very costly to switch lenders, so mortgage holders should have all the facts first. Borrowers at this time must prepare for higher payments and budget accordingly. If the increase is creating financial hardship, their first call should be to their lender, who has the power to help them, he said. If the lender will not or cannot help, refinancing is an option, and borrowers should consult a broker who will act in their best interest and provide options and work on solutions that take into consideration their individual circumstances. And White said refinancing should only be done if it was in the best interest of the borrower. A different lender may offer a more competitive interest rate than what the borrower currently has, so will be willing to offer other benefits like providing the borrower with an ability to do an extension or add a pool or consolidate debts, he said. The math must make sense as there are costs involved. Depending on circumstances, there may be stamp duty, legal fees, valuation fees and lender's mortgage insurance, so borrowers must aim to get a better deal that mitigates the cost to move. And White said the first step should be to have a conversation with your current lender around negotiating a better deal to refinance your loan. This could mean you can stay where you are and don't need to refinance. But if this can't be achieved, you might be able to move elsewhere with a cheaper interest rate, even when rates are rising, he said. There has to be a tangible benefit for refinancing to make sense. And White said rate hikes were starting to make it very tough for many people. While I understand the RBA's objectives, I also hope that they take into consideration the wider community and social ramifications when considering future rate increases, he said. There is only so much that consumers can handle, and after 3 large increases, I hope there is some relief in coming months. So 3 very important points I want to make here. The first is that there are more people who are being encouraged forcibly to sell, one reason why listings are rising, than may be actually being exposed through, quote, mortgagee sales. Second, interest rates are indeed rising, and most banks have passed on the full rate rise from the RBA, and there's another one coming shortly. So people need to be preparing for higher interest rates ahead. And thirdly, the refinancing situation is very important. People quite often are not on the best available rates and frankly seem very lethargic about switching to those better rates, despite the fact that refinancing is now stronger than it has been for some time. And it is important to shop around. Mortgage brokers can indeed help, but I would make the point that not all mortgage brokers have access to whole of market offers. So it's very important when you speak to your broker, if you do use one, to understand their breadth of access to information about the various products and services that are out there from some of the smaller lenders and non-bank lenders in particular. But finally, this very important point must be front of mind. If you are going to a new lender and getting one of those cheap new loans, read the small print, because quite often at the next reset, the rate will go up significantly. And unless you proactively manage it at that time, you will then be on a much higher trajectory. This is one reason why so many people in our surveys are paying mortgage rates currently with a 4 or a 5 in front of it, and therefore are paying more than they need. And given the fact that this is a very important factor affecting household balance sheets and incomes, it amazes me that more people aren't being more proactive and searching out the cheapest rates that are there, and also constantly monitoring it later, because that's the final point I want to make. This is not a set and forget situation. It's worth keeping a track of what your rate is. Do you know what it is now? And also continuing to shop around to see what the best rates that are available are. And if you see a better rate, no harm in asking your own lender to match it, because at the moment, quite a few of them will be prepared to keep you at almost any cost. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.